If you blinked today, you missed it. Silver didn't dip, it got yanked. One session, one flush. Spot printed around $74 and the timeline lit up like a fire alarm. People are screaming manipulation. They're not wrong, but they're staring at the wrong battlefield. Because while New York was dumping paper, Shanghai was paying up for real metal, around $82, even spiking higher earlier. That spread isn't a premium, it's a siren. It's the sound of a market split in half. Paper on one side, physical on the other. And here's what matters. This split didn't happen because of a rumor, a tweet, or a chart pattern. It happened because of a legal line that almost nobody read. A quiet update buried in an executive order. A small annex. A tiny carve-out that just turned silver into a weapon inside the trade war. So here's the event, plain and simple. The US just built a tariff wall around finished goods and left a tariff-free tunnel for bullion. That tunnel is now sucking physical silver toward American industry, while Asia is paying more to keep it. Two vacuums, pulling against each other. And when vacuums fight, something breaks. Now watch this. The paper price falling to $74 isn't proof the rally is over. It might be the last shake before the law forces a repricing. We're going to walk through the mechanics, step by step, in a way that actually helps us make decisions, not just feel emotions. And yes, quick disclaimer, one line. This is educational, and we manage risk. All right, first, the law. Buried inside Executive Order 14346 and its annex modifications is a simple incentive. Certain bullion-related imports are treated differently than almost everything else. While tariffs slap finished products, certain raw metal categories slip through. Fact. The trade policy hits finished stuff hard. Interpretation. It forces factories to relocate and it forces raw inputs to become strategic. This is the part most people miss because they hear tariffs and they think stocks down. But tariffs are not just taxes. Tariffs are steering wheels. They don't just raise prices, they reroute supply chains. Picture global trade like a highway system. Tariffs are toll booths, and this executive carve-out is a hidden express lane marked bullion, free pass. So what happens when you tax the solar panel, but you don't tax the silver that goes into the panel? You create a brutal incentive to bring the assembly line home and import the raw metal instead. That's not ideology, that's math. If a finished imported product gets slammed with a huge cost, it becomes uncompetitive overnight. But if the raw input is exempt, the same company can rebuild inside the US and keep margins alive. Now ask yourself a question that should make your stomach tighten. If industry suddenly needs a flood of raw silver, where is it supposed to come from? Because the United States consumes a lot of it across electronics, medical, defense, and energy. And US mine output is not built for a sudden industrial binge. We don't have a faucet we can just twist open. Mines are slow, permits are slow, ore grades are slow. The law is fast, the demand shock is fast, and that mismatch is where squeezes are born. Now here's the twist. While the US carved out a lane to pull silver inward, China tightened the gate on the way out. Call it export controls, licensing, strategic resource management, whatever label you want. The result is the same. Fewer ounces leaving, more ounces being bid for domestically, and a higher local price to prove it. That Shanghai spread is the receipt, and spreads like that don't just sit there calmly. They invite arbitrage, people buying where it's cheap and selling where it's expensive. But arbitrage only works if metal can move. If the door is closing, the spread doesn't close. The spread widens. This is why today's chart can lie to you. The paper market can print lower prices, even while physical markets scream scarcity. It's like watching a casino scoreboard while the vault behind the casino is empty. The scoreboard can show whatever it wants. The vault can't. So why did price drop so hard today if the setup is so tight? Because the paper world has its own gravity, leverage. Fact. Futures markets run on margin. Interpretation. When margin gets raised, weak hands get forced out, even if the fundamentals are bullish. Think of margin calls like oxygen masks. When the exchange turns the oxygen down, the leverage traders gasp first. They don't sell because they change their mind. They sell because they can't breathe. And that's exactly when the strongest buyers step in. Not the loud buyers on social media, the quiet buyers with procurement calendars, the buyers who don't care about RSI. They care about keeping factories running. Now we have to zoom out and see the bigger machine this law is feeding. Because this isn't just about investors stacking coins. This is about a forced migration of manufacturing. If you're a solar company, your choice is brutal. Stay offshore and pay the tariff tax on every finished unit, or rebuild in the US and source raw materials into the new plant. That's why this is bigger than a chart. This is the collision of policy and periodic table, and silver isn't optional in a lot of modern tech. We can thrift around the edges, we can reduce loadings, we can redesign contacts, but we can't cheat conductivity forever. and we can't wish away physics with a press conference. So the first takeaway we need to lock in is this. This is a policy-driven demand shock, not a meme, not a fad, a legal structure that changes behavior. Second takeaway, the physical market is already telling us the truth through regional pricing. The paper market is trying to tell us a story through forced liquidations. The question is, which one wins? Spoiler, physics tends to win. But there's a third layer that makes this nastier, your currency. Because tariffs are taxes, and taxes in the supply chain become price increases at the checkout. That's cost-push inflation. You feel it in appliances, cars, building materials, anything with imported components. Normally, the central bank fights inflation by raising rates. But here's the trap. If rates rise too much, the very reshoring boom the government is trying to ignite gets strangled. Factories are debt machines. They need cheap capital. So if inflation rises because of tariffs and rates can't rise because of industrial policy, what happens? The currency absorbs the hit. Your savings account becomes a melting ice cube. And when that happens, people run toward assets that don't get printed. Now notice how convenient the bullion carve-out becomes in that environment. It's like the policy quietly admits something no politician wants to say out loud. We're going to make stuff more expensive. We're going to stir inflation. And the hedge will be the metals we didn't tariff. That's not conspiracy. That's incentives. Now, let's talk about the gold-silver ratio because it's a brutal truth serum. Gold has been acting like a lie detector for currency stress. Silver, meanwhile, is half precious metal, half industrial input. When the economy shifts into inflation plus scarcity, silver doesn't just move, it snaps. In those environments, the ratio compresses. That doesn't mean silver must do anything. Nothing is guaranteed. But it gives us a framework. If gold stays high and silver stays artificially low, the tension builds. And tension doesn't release gently. It releases like a spring. So we need to be honest with ourselves. Fact. Silver is trading far below the physical bid in parts of Asia. Interpretation. The paper price is lagging the real clearing price for deliverable metal. Now, here's where we get to the part nobody wants to think about. What happens when industrial buyers stop accepting paper promises? What happens when the buyer is not a hedge fund but a manufacturer? A manufacturer can't settle in cash. They can't solder a circuit with dollars. They need atoms. If they show up for delivery and the warehouse can't deliver, the whole credibility stack shakes. This is how paper markets crack. Not because of ideology, because somebody finally demands the thing the contract claims to represent. And that's why today's dump might be more important than it looks. It may be the margin flush that clears out leveraged tourists right before the delivery crowd shows up. Do you see the psychological warfare? They drop the price. You get scared. You sell. The strong hands buy. Then the narrative flips, and you're chasing higher. Now, I'm not telling you what to buy. We're not gambling. We're measuring. So what do we measure next? We watch the spreads. We watch delivery inventories. We watch premiums on actual product, not just the ticker. If paper falls but physical stays firm, that's not weakness. That's divergence. And divergence is usually the prelude to violent convergence. Here's the part that should keep you locked in. This situation has a built-in countdown. On one side, factories are being planned, financed, and built. On the other side, export controls and domestic hoarding are tightening. Once the U.S. industrial machine flips from planning to ordering, the demand isn't theoretical anymore. Purchase orders don't care about your emotions. They clear at whatever price gets the metal delivered. So let's be blunt. If the U.S. has a tariff wall pushing finished goods away and a tunnel pulling raw bullion in, and Asia is paying more to keep its metal inside, the clearing price cannot stay where it is, not sustainably. The only question is how the adjustment happens. Slow grind or sharp gap? And the adjustment won't be polite, because the paper market is loaded with leverage and short exposure. When a levered market is forced to reprice, it doesn't walk, it jumps. And here's the subtle part. The exemption doesn't just help big industry, it rewires shipping routes. Refiners, wholesalers, and vault operators start treating the U.S. like a preferred destination for raw bars, because the paperwork is cleaner and the tariff bill is zero. That pulls metal out of places that used to feed Asia. Meanwhile, Asian buyers respond the only way they can. They bid higher, they lock contracts, they stockpile. That's how you get a spread that feels impossible. So if you're wondering why the move feels sudden, it's because the law flips incentives overnight, but the mining supply can't respond for years. And once that game starts, the chart becomes theater until somebody fails delivery and admits the shortage. Now, quick engagement check, because I want your brain on, not just your ears. If Shanghai is paying $82 and New York is printing $74, what do you think closes first, the spread or the inventory? Drop your answer in the comments. I read them, and it tells us what the crowd is missing. And one more question for you, because this is the real game. Do you think governments will let retail investors compete with industry for strategic metals, or will they try to allocate supply? Tell me what you think and why. Now let's talk strategy without turning this into a sales pitch. The mistake most people make is they treat silver like a trade. They scalp it. They stare at 5-minute candles. But this setup is structural. Policy plus supply chain plus physics. That's not a day trade. That's a regime shift. In a regime shift, the chart is the last thing to catch up. The law moves first, the procurement order moves second, the price follows third. So our job is to stay ahead of the third move without getting shaken out by the second. And that means respecting volatility, because the banks and the exchanges know exactly where your pain is. They know where your stop losses sit. They know how to trigger forced selling, and they'll do it again. Not because they hate you, because it works. Here's a metaphor you'll feel. Imagine a dam holding back water. Paper selling is the dam operators opening gates to scare swimmers away. Physical demand is the rainstorm upstream. You can open gates for a while, but you can't stop the storm. At some point, either the dam raises prices to slow demand, or the dam breaks and the river sets its own price. Now, we should address the credibility piece, because it matters. Some people will say, this is all hype. Price dropped, so you're wrong. That's lazy thinking. Price drops happen in bull markets all the time, especially when leverage is involved. So we separate the pieces. Fact, price dropped sharply today. Fact, the Shanghai bid is materially higher. Fact, trade policy is creating divergent incentives for raw inputs versus finished goods. Interpretation, the paper market is being used to shake out risk before the physical market forces repricing. If we're wrong, where will it show first? It will show in the spreads collapsing without inventories tightening. It will show in physical premiums fading. It will show in import flows reversing. That's what we watch. And if those signals flip, we adapt. Because again, we're not gambling, we're measuring. Now there's one more cliff edge we have to stare at, and it's the moment the spread becomes a headline. Right now, most people don't even know it exists. They're watching the US spot chart and taking it as reality. But when the mainstream finally notices that physical silver is trading meaningfully higher in Asia, the conversation changes. It stops being, is silver a hedge? It becomes, why can't we get it? And that's when the rush begins. Not from retail, from industry. From funds that can't be seen on a chart until it's too late. From entities that don't ask permission. That's when paper shorts start to feel like standing in front of a train. So here's what I want you to do right now. Not next week, not when it confirms. Right now. Stay sharp. Watch the real indicators. And if you want more breakdowns like this, fast, no fluff, hit subscribe. One button. That's it. Because the next move in this story won't be a gentle dip. It will be a policy headline, a shipping restriction, a warehouse number, and then a gap. And when it gaps, the people who sold at $74 won't get a do-over. Now hold on to this final thought as we end. The law created the tunnel. Shanghai is showing the price. And the paper market is trying to convince you the tunnel doesn't matter. But tunnels don't care about opinions. They care about flow. So the real question is not, will silver go up? The real question is, when the flow accelerates, who gets the metal first? Us or the factories? Because that answer will decide the price. And the next time you see a red candle, you might realize it wasn't a warning. It was bait, and the trap is about to snap.